Hello and welcome to the latest episode of On the Money, our weekly look at how to get the most out of your savings and investments. For this episode, I'm joined by friend of the pod, Sam Benstead, to discuss speculation that the inheritance tax break that most AIM stocks have may be removed in the upcoming budget, which takes place on the 30th of October. But firstly, let's take a step back. What is the AIM market? So, in a nutshell, it is the London Stock Exchange's market for small-sized growth businesses. And as we'll come on to later on in the podcast, AIM stocks tend to be volatile, high risk, potentially high reward investments. On the AIM market, you'll find up-and-coming businesses, as well as some well-established firms like Fevertree. To encourage investors to invest in this market, and in turn help smaller companies to grow, the IHT exemption for AIM shares was introduced over a decade ago, alongside AIM shares being eligible to be held in tax-efficient ISAs. And around the same time, there was also the abolition of stamp duty in AIM shares. AIM qualifies for IHT relief because it is not deemed to be a designated, recognised stock exchange, as the shares are of a small size. Not all AIM shares qualify, however, for IHT. There's not a specific list of rules. Instead, it's at HMRC's discretion. So you need to be careful. You don't just blindly pick any company on AIM, as they mightn't qualify for IHT. However, generally speaking, the majority qualify, and the majority are those that are trading businesses and not investment companies. If an investment in a qualifying AIM company is held for at least 2 years, it will not be subject to IHT. This is known to investors as IHT relief. Now, Sam, the first thing to stress is that it is just speculation. There's nothing concrete, but there is a lot of concern among fund managers that invest in AIM stocks that the IHT sweetener may be taken away.
Yes, absolutely. And it's going to be a long 3 weeks counting down to the budget for AIM investors. And if I was managing an AIM fund or a UK stocks fund which had some AIM shares in it, I'd also be a bit worried. So Simon French, head of research at stockbroker Panmure Liberum, said that in isolation, the removal of the IHT break could be a systematic risk for AIM, while other analysts have said that it could cause severe disruption to the market. The thinking is that if AIM shares lose their tax break, that means that a lot of money that is invested in those companies just for that tax break could actually leave the market. If money's leaving AIM, which is relatively illiquid versus the main FTSE indices, then actually it could send prices down. It's anyone's bet where prices will go, but it's not going to be a positive thing for the market, in my opinion.
Of course, no one knows how big a market sell-off would be for AIM-listed stocks, but I do agree with Sam. In my view, I think it could be notable. No one knows exactly how much is invested in AIM for tax planning reasons. However, I've seen suggestions that between 1/5 and 1/3 of money invested in AIM is for tax planning reasons. I suppose the severity of a potential sell-off depends on, if this tax break was taken away, whether it's done in an orderly manner or whether the exemption is taken away very quickly. I saw a piece recently in the Financial Times which reported that the chief executive of the investment bank Peel Hunt, who is Stephen Fine, wrote to the Financial Conduct Authority to warn that removing inheritance tax relief on AIM-listed companies would trigger a sell-off in the market that could wipe up 1/3 off its value. Now, the figures show that dropping this inheritance tax relief from AIM shares would raise 1.1 billion in the current tax year. And those figures are from the Institute for Fiscal Studies. Now, on the one hand, those who want the IHT sweetener to remain point out that the tax break helps to encourage investors to invest in this market, and it gives these businesses capital to help them grow. And in turn, by extension, this should benefit the UK economy. However, on the other hand, it does seem odd to me that you have to pay stamp duty on other UK shares that are not listed on AIM. And a point made by the chief executive of Interactive Investor, Richard Wilson, is that abolishing the IHT exemption on AIM shares could go some way towards paying for the abolition of stamp duty on UK shares, which he describes as a blight on the investing landscape, which I completely agree with. There are around 30 major fund managers offering AIM IHT portfolios. So generally speaking, these portfolios tend to go for the larger dividend-paying companies. The major stakes tend to be in the FTSE AIM 100 constituents. These companies are the most liquid, meaning they're the easiest to buy and sell, rather than companies that are of an even smaller size. And as well as there being various AIM IHT portfolios, there are a number of funds, particularly UK smaller company funds, that invest in the AIM market. Now, bear in mind, these funds do not give investors the IHT relief. Sam, you took a look at funds that have big allocations to AIM. Could you talk us through them?
I did, yeah. And this was a really interesting piece to write because I wasn't actually sure how much of these UK smaller companies would typically have in AIM. But in some cases, it's a lot. And you might not actually realize if you're invested in one of these portfolios. So, for example, the £129 million Lion Trust UK Microcap Fund has 88.7% invested in AIM shares. Gresham House UK Microcap has 73.5% invested there. So microcap, that's a bit of a trigger word in terms of AIM. It means they're investing in the smallest companies in the UK, indicating AIM exposure there. Schroeder UK Smaller Companies has 38% in AIM shares. Meanwhile, other researchers found that Lion Trust Special Situations, which is a large and very successful UK equities fund, has 22% there. Gresham House UK Multicap Income, 28%. And Invesco UK Smaller Companies, 29% in AIM. Some fund managers were a bit reluctant to reveal the exact figures, but Stonehenge Fleming AIM said it mainly invests in companies there, and Marlborough Nanocap Growth has significant exposure according to the fund manager. And I've seen more figures that suggest there is 8.3 billion invested in AIM shares by UK funds, and that accounts for 16.5% of the AIM all-share index. So significant exposure via these regular UK smaller companies options that many investors are drawn to.
And as well as it being difficult to ascertain how much a fund has in AIM, as when you were researching this piece, Sam, most fund groups don't split it up and say on the fund fact sheet we've got X% in AIM. You also found that most of the fund managers you approached for comments were very tight-lipped about this potential for IHT to be removed from AIM.
That's right. So hardly anyone wanted to go on the record and talk about the possible coming tax changes. And some of the fund managers wouldn't actually give me the exact amount of their portfolio which was invested in AIM. So some did on the fact sheet, some did after comments, but some were very reluctant to, which after lots of time in the investment journalism world, this indicates to me that there could be a story here. And actually internally, they may be a little bit worried about coming tax changes and the impact that could have on the share prices of the holdings of their portfolios, but also on flows into their funds as well.
I completely agree, Sam. The fact that fund managers being very tight-lipped over this shows that there's definitely something in this. And I spoke to a fund manager off the record who invests in this part of the market, and he told me that it is something that the Labour Party has been taking a close look at. However, he thinks that Labour won't make the move. He thinks that instead, Labour will want to boost productivity in the economy rather than potentially harm that. So, Sam, could you put some figures on how big the AIM market is? And do you think it is deep enough to withstand a big market correction?
The market cap of the AIM index is a little under £50 billion, so it's not insignificant. And in there, we have 611 companies and it yields just over 2%. So it's a big market, but it's dominated by some large companies. So we have the likes of Jet2, Fevertree, YouGov, which are probably household names here in the UK. But there's also some investor favourites there, which you'll see appear in lots of UK smaller companies funds, which have done really well and they have a technological edge over competitors. So companies like Gamma Communications, Keyword Studios, Craneware and RWS Holdings are definitely investor favorites, which I hear spoken about quite a lot. So on the index, you've got a real mixture of tech shares, consumer goods companies, financial services, and of course, it wouldn't be a small cap market without lots of speculative mining companies in there as well. So the AIM index, I'm looking at the all share here, hasn't done amazingly well, to say the least. So over the past decade, it's risen. This is a total return figure, just 15%, and that compares with 87% for the FTSE All Share, which has hardly been a standout performer globally either. Over 5 years, the AIM All Share is down 8.5% versus a 37% gain for the FTSE All Share Index, and over 3 years, AIM All Share is down 36% versus a 26% gain for the FTSE All Share. And this is really interesting because it shows that actually that tax break hasn't really led to, well, it hasn't helped returns at all. It's really underperformed the mainstream index. And if you were very concentrated in AIM shares for the IHT break, actually, you probably haven't done too well unless you've managed to find some of the small number of big winners in AIM. But even then, some of the star performers have really come undone recently. So Fevertree and Boohoo, once darlings of the AIM market, have had a tough couple of years.
Well, the performance for the index as a whole, to me, shows it's very volatile. It's not for the faint-hearted, and it's certainly not a market you'd want to own passively through an index fund or an exchange traded fund, an ETF. Instead, you'd want to be putting your trust in fund managers to pick the potential winners over time, or do your own research and potentially pick some shares yourself. Whether or not the tax break remains, I think now is a timely reminder of the old saying that don't let the tax tail wag the investment dog.
Yeah, definitely. And there really is a clear risk of a market sell-off, and that could add just to the woes of AIM investors over the past few years and actually decade, really. But in any sell-off, in any crash, there's always opportunity. So it might actually be time to actually look at some of these leading UK smaller companies funds, look at these top fund managers which do invest in AIM. And if you're not with them already, maybe you could actually add them to your watch list and see what happens in the AIM market. If you do get a big sell-off there, it might actually be quite smart to look at some of those UK fund managers which do like AIM and potentially looking at adding to their portfolios so that you can trust them to find the opportunities in the market when actually the selling might be quite indiscriminate. Fund managers love these kind of situations. It just all depends on how AIM does long term and whether that market survives. But on that note, if AIM does collapse, and I'm not saying it will, then it could see some of the better companies actually upgrade to the main market, where they may benefit from a larger profile and increased liquidity, which might be a good thing long term for their share prices.
Well, thanks to Sam, and thank you for listening to this episode of On the Money. If you enjoyed it, please follow the show in your podcast app and tell a friend about it. If you get a chance, leave us a rating or a review in your podcast app too. Join the conversation, ask questions, and tell us what you'd like us to talk about via email on otm@ii.co.uk. And in the meantime, you can find more information and practical pointers on how to get the most out of your investments on the Interactive Investor website at ii.co.uk. And I'll see you next week.